Hello, and welcome to the first episode in a new series of short updates about the world of UK tax. You'll be able to watch a new episode every 2 weeks. I'm your host, Andy Rainford, tax advisor, content writer, and editor-in-chief of the Tax for Professionals newsletter. In these fortnightly updates, we'll look at the latest tax-related news. For ease of reference, this will be presented in 3 subcategories. First, we'll cover general news and announcements. In this first episode, topics include late payment interest and what the new tax year brings for employers. Next, we'll see what HMRC has been saying. This episode's topics include the publication of an important new manual and a change in how you can reclaim overpayments for clients. Finally, we'll cover any cases that have caught my eye and discuss what the key takeaways are. So let's get started. There has been a permanent change to the way interest is charged on late payments. Unsurprisingly, it's bad news for taxpayers. The late payment interest rate has long been pegged to the Bank of England base rate. Historically, it has been set at the base rate plus 2.5%. However, this has increased to 4% with effect from the 6th of April 2025. The current level of the base rate means the new late payment rate is an eye-watering 8.5%. Impress on clients that early payment is more important than ever. A time-to-pay arrangement is great for avoiding late payment penalties, but it won't dislodge the interest burden. Note that the way overpaid interest is calculated has not changed. A further important change from the 6th of April affects the off-payroll working rules. These are the rules that mean large and medium organizations have to determine the employment status of contractors and deduct tax and national insurance where applicable. Small organizations do not need to comply with these rules. Instead, the responsibility for determining employment status is shifted to the contractor, usually a personal service company, under the older IR35 rules. These apply where services are provided through an intermediary and affect the way the underlying worker is taxed. The financial thresholds for defining a small organization have been increased. An organization will be small for these purposes if any 2 of the 3 conditions shown here are true. As you can see, the thresholds relating to turnover and balance sheet value have increased. This may mean that medium-sized organizations operating just above the old thresholds may not fall within the off-payroll rules in future. However, advise clients to exercise caution, as the tests are measured by reference to the previous tax year. In practice, nothing will change until at least 2026. We're partway through the first month of the new tax year. Now is a good opportunity to remind your employer clients about the myriad of changes they need to ensure they adhere to. Firstly, the national living and minimum wage levels have been hiked significantly. In the case of the national living wage, it is now £12.21 per hour. Remember, since 2024, the relevant age reduced from 23 to 21, so anyone reaching their 21st birthday will need to be paid the new rate. Increased wages also means increased employers' national insurance. This will have a bigger effect this year, as the secondary Class 1 rate increased to 15% from April 2025. In a double blow, the payment threshold was also cut to just £5,000. Smaller employers will be cushioned from this due to a large increase in the employment allowance, which is now £10,500. This offsets the first £10,500 of secondary Class 1 contributions, so will mitigate, or in some cases remove, the additional burden. Let's move on to see what HMRC has been up to over the last few weeks. As you probably know, domicile is no longer relevant for direct tax purposes. There will be no scope to claim the remittance basis to avoid tax on overseas income or gains, regardless of whether the funds are brought into the UK or not. Instead, a new foreign income and gains regime, FIG for short, applies for new arrivals. HMRC has now published a new internal manual for the FIG regime, and this can be found on the government website. It's concise and well written, and explains the key concepts in plain English. Of course, we will be publishing our own content on tax essentials for advisors over the coming months, and we will be proactively highlighting saving opportunities, as well as explaining the rules. Oh dear, more security problems. This time the focus is on fraudulent repayment claims. This has led to the department now refusing to issue repayments of tax, where the claim is made over the phone by an agent. Instead, the claim can only be made via a tax return or from within the agent services account. It's not clear whether this is a temporary pause or the permanent shutdown of this type of refund claim. A consultation is currently running that you might be interested in responding to. It's about how a new process for advanced clearances for large investment projects might work. The aim is to provide certainty about the tax treatment of transactions in advance. As you can see from the content I've included here, it's unlikely that any of your clients will be affected. But the government is seeking feedback, and if you wish to partake, I've put the URL here for you. On to tax cases then, and sadly, both of this week's are losses for the taxpayer. In this first case, the taxpayer had made significant loans to a trading company. The company subsequently struggled and was unable to repay the loan in cash. Instead, it transferred some assets as a part settlement. The remaining £2.2 million was converted into shares. The company was later liquidated. Initially, the taxpayer tried to make a negligible value claim, but this failed as the shares were found to have already been worthless when he acquired them. Instead, he claimed capital gains tax relief for an irrecoverable loan to a trading company. HMRC rejected the claim, but the first-tier tribunal agreed with the taxpayer. I must admit I was surprised at the decision when it was published last year. I expected that there would be an appeal, and sure enough, that has now transpired. The upper tribunal overturned the first decision. This was because the loan could not be said to be outstanding, as it had been satisfied by the issue of shares. The fact that those shares had no value was unfortunate, but irrelevant due to the wording of the legislation. The tribunal judge expressed sympathy, but allowed HMRC's appeal. This next case concerns a claim for business property relief, or BPR for short, by the executors of a deceased person's estate. The subject of the claim was a holiday letting business. The executors claimed BPR on the basis that a number of services were provided on top of the accommodation, and that this changed the nature of the venture to a business rather than an investment. It's difficult to comment on the merit of the claim purely based on the decision transcript, but the cited services were things like cleaning, maintenance, gardening, etc. To my mind, these are simply things that are part and parcel of a holiday let. I certainly wouldn't stay at a poorly maintained, unclean holiday cabin where the garden resembles the Day of the Triffids, but maybe I'm just fussy. Fussy or not, the tribunal agreed with my view, saying that most of the services were merely ancillary to the letting activity, and those that were genuinely supplementary were not sufficient to mean a business rather than investment was being carried on as a whole. Well, that's it for this inaugural tax update episode. Look out for the next episode landing in a couple of weeks' time. Please do keep watching for a short video introducing our award-winning AI product. It really can make a huge difference to productivity. If you like what you see and want to find out more, follow up with a demo with one of my very knowledgeable colleagues. They've even helped a pre-computer age relic like me to understand it. From me and the rest of the team at Tax Essentials for Advisors, thanks for watching and see you next time.